Hi, in this problem demonstration, we're going to get a little practice recording sales transactions for merchandisers. And our problem states the following transactions were selected from among those completed by Bear's retail store. And then we have a series of transactions, and our requirement is to prepare journal entries to record the transactions, assuming Bear's retail store records discounts using the gross method. That's what we've learned. In a perpetual inventory system. Okay, so let's take a look at these transactions. On November 20th, Bear's Retail sold 2 items of merchandise to Cheryl John, who paid $400, the $400 sales price in cash. The goods cost Bear's $300. Well, if you recall from our mini lecture or from reading the text, when you have a perpetual inventory system, you always have to keep that inventory account updated. So we are actually going to have to do 2 journal entries for every sale and every return when we have a perpetual inventory system. The first one is to record the sale at the selling price. So let's record that receipt of cash from the customer, $400, and we will credit sales revenue. Now we have to do an entry to take out of inventory what was sold. So we will debit the expense account called cost of goods sold, and we will credit inventory to remove from inventory what was sold. We want to keep that inventory account updated. Now, if we wanted to calculate our gross profit at this point, we could. The selling price of what we sold is $400. The cost of what we sold is $300, so we made $100 of gross profit on that sale. Let's take a look at our next transaction on the 25th. Sold 20 items of merchandise to Vasco Athletics at a selling price of $4,000 in total. The terms were $310 net $30, and the goods cost Bear's $2,500. Now, if you are wondering whether this is a cash or a credit sale, note that they gave us terms. When we see terms, it has to be a sale on account or a credit sale, because you wouldn't need credit or discount terms if it were a cash sale. You would have been receiving cash. So this sale is made on account. Okay, so we're going to debit accounts receivable instead of cash. For the selling price, we'll credit sales revenue. You might want to just say to yourself, sales are recorded at the selling price, and that will help you remember which of these counts to put together. The second journal entry is the same. Accounts used as November 20th. We need to take out of inventory what was sold. So we're going to debit cost of goods sold and credit the inventory account to remove what was sold. And remember, cost of goods sold is an income statement account, an expense account. Okay, so the cost of those goods were $2,500. Let's calculate our gross profit. The selling price of what we sold was $4,000. The cost of what we sold was $2,500, so our gross profit must be $1,500. Okay, let's take a look at November 28th. On November 28th, we sold 10 identical items of merchandise to Nancy's Gym at a selling price of $6,000 in total. And again, we have credit terms. So this sale must be on account. Nancy's not going to pay us right away. We're not going to worry about those terms until it comes time to receive payment. But this does give us the clue that it's a sale on account. The goods cost Bear's $4,000. So our entries will be just like on November 25th, except for, of course, the different amounts. We will debit accounts receivable, because we are not getting paid right away. This is a sale on account or a credit sale. and that amount is $6,000, and we will credit sales revenue. Sales are recorded at the selling price. Okay. Now let's update our inventory account by taking out what was sold. So we will debit the expense account called cost of goods sold for the cost of what was sold, which was $4,000. And we will credit inventory to remove those items from our inventory and keep that inventory account updated. Okay, so the bottom line is if you receive cash, you debit cash. If you don't get paid right away, you debit accounts receivable, and you'll receive that money later. Okay, now let's take a look at the 29th. On the 29th, Nancy's Gym returned one of the items purchased on the 28th. The item was in perfect condition, and credit was given to the customer. Now, they don't tell us how much each item is, what the selling price or the cost was, but they tell us on the 28th that they were 10 identical items, and the total cost was $6,000. So we can calculate what the cost of one would be, right? We take the selling price for $6,000 and divide by 10 because they're exactly the same each. So the selling price was $600. And let's see about the cost. If the total cost was $4,000 and we divide by 10 identical items, that's $400 each. So the selling price of each is $600. The cost of each was $400. They were a little tricky in that one. Okay, so let's record this. Now remember, the return is the reverse of the sale. So we're going to reverse the entries on the 28th, but for only one item. So we will debit sales revenue for $600 and credit accounts receivable also for $600. And then we will have to reverse the second entry, putting that item back into inventory because our customer returned it. And that would be for the cost of one item, $400, and we'll credit to reduce the cost of goods sold because the item is no longer sold. It's been returned. Okay. Next transaction. On December 6th, Nancy's Gym paid the account balance in full. Okay, so let's do a little T account for Nancy's Gym. It's going to be hard to squeeze it in here, but let's say we have an accounts receivable account here, and let's call it Nancy's. Let's post Nancy's transactions. We have a debit to accounts receivable of $6,000. And then a credit to accounts receivable of $600. So the sale was $6,000 and the return was $600. So the balance that Nancy bears is $5,400. Okay, so if she paid the balance in full, let's see first if she's eligible for a discount. Let's see. Oh, it was the one that just occurred, the sale on the 28th. We sold 10 identical items to Nancy's Gym, and the terms were 3% discount she could take if she paid in 10 days. Well, let's see. This is December 6th. I think she just hit it. There were 2 days in December. There's 6 days, well, really 3 if you count the 28th. 6 days in December. She's within the 10-day period, so she can take a discount. What's the amount of her discount? Well, it would be on the goods that she kept, on the $5,400. So let's calculate this off to the side here. 5,400 times 3% would be a $162 discount Nancy's can take. So how much will the check be that you receive? Well, let's debit cash for, let's see, she owed us $5,400. That was the original sale less the return, and now we're going to subtract out our $162 discount. And so the check you receive from Nancy should be $5,238. We will debit sales revenue for the amount of the discount. That's the money you're not going to receive. 162, and if you want, you can show the calculation of the discount there. 3% times 5,400, because you can only take the discount on the goods that you kept. 6,000 minus the $600 return. And then we're going to credit accounts receivable for the total amount that she owes you, for the $5,400. Now, why would we give her credit for paying us $5,400 when she only paid us $5,238? Well, it's because we told her she could. In our terms, we told Nancy that if you pay us early, you can take a 3% discount. If you pay us within 10 days, you can take a discount of 3%. So we gave her permission to do so. If we only credited that account by $5,238, which is the amount of the check, then it would look like she still owed us $162. There would be a balance remaining. And she really doesn't owe us any money. We told her to pay us less because she's paying us early. Okay, so we're at the end of our journal page here. We're going to have to do our last journal entry on the next page, and that would be for Vasco Athletics. They're paying us in full for the invoice of November 25th. And Vasco Athletics also had terms of 3% in 10 days. And 10 days from November 25th would have been December 5th, and he's way beyond his discount period. So he's going to have to pay you the full amount that he owes you, or $4,000. So the entry for December 30th would be a debit to cash for $4,000. That would increase your assets. And a credit to the other asset, accounts receivable. Remember, we have to reduce the amount he owes us in our accounts receivable account because he is now paying us. And we're done with all of our journal entries. But now they want us to calculate our total revenue. So there's a few different ways we can do this. We can create a sales revenue T account if we'd like. And we could just post in there all the transactions that we've recorded. So we have a credit to sales revenue on November 20th, $400. And then we have a credit to sales revenue on November 25th, $4,000. And then we have a credit on the 28th of November for $6,000. And let's see what else we have. We have a debit to sales revenue on the 29th. That was for a return, $600. And then finally, a debit to sales revenue for the discount on December 6th. So our total credits come to $10,400. Our total debits come to $762. So the balance of that sales revenue account is $9,238. $9,638. That would be our total revenue. Another way to do this is you could simply list the sales. November 20th, 400. November 25th, 4,000. November 28th, 6,000. November 29th, we're subtracting there from sales, so we're going to have to show that as a minus on the 29th. And then on December 6th, again we're subtracting from sales a debit of 162. And if you add all of those down, you're going to come to $9,638 as well. And that ends our demonstration. Have a great day.